What is more expensive, whole life insurance or index universal life insurance? A lot of the videos that I make, I get comments from people that know that I am kind of in the whole life camp. I believe whole life insurance is a better product than index universal life. I don't shy away from that. I get a lot of pushback and a lot of feedback from people saying that IUL is a cheaper form of insurance than whole life. So I figured I'd make this video going through and breaking down how index universal life works, how insurance is actually charged, what it's paid for. I know a lot of people say that IUL is a more transparent insurance because they show you exactly what's what. Well, in this video, I'm gonna talk to you about the transparency and the clarity behind IUL, some of the lack of transparency in whole life, what that means to you, how you decipher all the information, and ultimately how you can make a better decision for yourself. Obviously, I'm using one example, but I'm going to use this example to teach some principles and concepts, and so you can look at any company, understand what to kind of evaluate, and go from there. If you find this information valuable, I would ask that you subscribe and hit the bell, that way you're notified every time I launch a new video, and share this video out with other agents in other groups or whatever, because I think it's really important that agents understand this. There's a lot of changes happening in the IUL space right now. With updates to regulation AG 49A, the whole landscape is going to be turned on its head with illustrated rates for income, the ability or lack of ability to illustrate the same way the positive arbitrage, because it's been a bit of a smoke and mirrors game in the illustrations. And this video, I'm going to kind of touch on all of that, so make sure you stay tuned, and we'll see you in there. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and in this video, we are gonna cover the cost of insurance of index universal life, cost of insurance for whole life insurance. I'm gonna bounce around from illustrations. I'm gonna look at some policy expense reports, and I'm gonna ultimately break down and talk about the different variables that go into what are the actual charges of IUL. Now, behind me on my board here, I have some information that I want to share with you. So let's just get right into it, not beat around the bush a whole lot, and let's go. So you can see here, this is a supplemental illustration, a part of the illustration on the Transamerica. So full transparency, this is just a Transamerica Financial Foundation IUL. There are other IULs, I know that people sell. I'm not a big fan of this product, but I wanted to find a product that had a good breakdown of the way the charges worked. Here, each column, kind of break it down, because this is a pretty clean look at what things are and kind of how things work inside of these policies. Once you understand this, then we can kind of get to the next level so you can understand how these charges are impacted, and ultimately what happens based on the performance of this policy, and how that will impact future charges, if that makes sense. So I think the first thing to understand as we get into this is that, actually I'm gonna go here. The first thing to understand is this is option B. So the death benefit is option B, right? Which is increasing, because you can see right here, the death benefit is growing every single year. So as the policy value grows here, so there too does the death benefit, right? It goes up, right? So that's important to understand. So now that we've got that kind of covered, you understand this is an increasing death benefit policy. What we're going to do is we're going to talk about what does that mean? So how does this work? Well, what these policies do is they function with an annual, they function with an annual renewable term. And so with the annual renewable term, we'll just call it ART, right? With the annual renewable term, the cost of insurance is based on the net amount at risk in the policy. So you can see here, there's a base net amount at risk. This is basically what the insurance charges are based off of. So this is what the expense of the policy is, because as the cash value grows, the death benefit grows. So you can see what you basically have here is $469,894 minus $1,894 equals the $451. That is the base net amount at risk. And so that leads to the charges. So the first year, just to kind of keep it really simple, you put in $20,000. There's a $800 premium expense charge. The cost of insurance and other riders admin charges is $1,474, and the policy fee is $120. So what does that mean? That means year one, you go 1474, 800, 120, you go 4, 9, 12, 13, $2,394. So your total charges are $2,394 year one. If you break that down, $2,394, wow, on as far as fees go, year one, mind you, are $2,394. You're looking at about almost 12%, 11.97%, right? And so, you know, no big deal because at the end of the day, that is not the end of the world. The policy value here, though, it's important to understand, and I'm not going to get into this. I got other videos that get into details on this. This is not how much money you have liquid in the account. That's just the policy value. Then you have to take out surrender charges, right? Surrender charges. You have to take those out of that. So out of that $18,000, my guess is for most people, you probably have $5,000 to $6,000 liquid in that policy. So, you know, it's not really super strong when it comes from that perspective. But you can see every year, let's just hop down to year 10, and you could see here that the cost of insurance, admin charges, rider charges, by the time we hit year 10, they go up to $3,411. Now you could see they go down here a little bit for a period, then they go back up. I'm not honestly quite sure what's going on with that. The interest crediting is a big thing. So what I'm going to do here is I'm going to erase a little bit of this so you can see, because what we have to do is we have to come up, I want to keep this as clean as possible for you. What we have to do is we have to come here and we have to take a look at this and we have to say, okay, we have all these expense charges and then we have the interest credited, okay? So that interest credited in this column right here, that interest credited is based on this 6% assumption. So when they say that the assumption is you're going to earn a 6% crediting rate based on participation in the market through the indexing strategy, that is the assumption that they're making. Now, that is never going to be a net number with them. That's not ultimately, it's not that clean, right? So what's going to happen is, this is the challenge. When you look at an illustration, it's assuming these things, because remember, this illustration is simply a projection based on current assumptions, and when you're utilizing a 6% assumption and it's unrealistic that that's going to happen, when in reality this policy is probably going to operate more in the 4.5% range, I should say. When it operates in the 4.5% range, that means this interest crediting is actually going to perform way worse. Now, what does that mean? So let's just go here. Let's just go, I'm gonna hop over here just to kind of keep it simple, and let's just go into a policy just to look at where the fees are and so on and so forth. And let's assume that you have I'm gonna take a 60-year-old, okay, or a 65-year-old. Let's take a 66-year-old after they stop funding it. A couple things that I want to touch on right here, and this is why I always tell people IUL is more expensive than whole life, because what whole life does is they take the entire life of the policy and it's a little more expensive on the front end. There's no denying that, but there's no free lunches in this world. And at the end of the day, the cost of insurance as you go down with IUL is completely astronomical. So, and here's what I mean by that. I don't know if you know this, but in a whole life policy, at 65 years old, you can have a life insurance policy, your whole life policy, 100% paid up contractually, meaning it's 100% paid for. All of your insurance fees have been covered. They've been paid for. There are no more charges. It's just going to be operating efficiently. It's going to grow. You're going to get all the growth of the dividends and the benefits and everything that come with it. But the insurance itself is fully paid up. You have no more charges, no more expenses, no more fees, no more anything. You can do that as soon as 65 years old with a lot of our carriers. The problem with Index Universal Life is that you can never really truly pay up an Index Universal Life policy. What do I mean by that? Well, you could see here that it looks weird because you're like, oh, well, my premium outlay, they stopped paying at 65 years old. So it's showing zero in premium. It's showing zero in premium outlay. So I paid this policy up. Well, in fact, you didn't pay this policy up. You can still see that these charges are still coming out of the policy. 14.4, 14.699, 15.385, 16.497, boom, boom, boom. You can see all the way at 19. By the time you hit 75 years old, you're paying 22, 21, 20, 19. And then in 76, by the time you're 80, you're paying 34,000 a year. These are all fees that are insurance charges that have all happened. The charges that you will pay for your Index Universal Life just for the cost of insurance on this after you turn 65, those fees alone are going to be more expensive than what you paid for the insurance for the entire life of the policy up until you turn 65, assuming you started at the same age this person started. Now, what are we doing here? This is all based on certain assumptions. Now, this is utilizing option B, right? Option B, and then transitioning to option A at 65 years old. Okay, so what does that mean? At 65 years old, you can see this little asterisk here. That means that's when it transitioned to an option A in the policy. Okay, so as it transitioned to option A in the policy, that's when the cost of insurance gets leveled, and you can see that the base net amount at risk here, even though it was flat at 451, it's going to illustrate that it goes down. It's going to illustrate that this goes down. Now, once again, now we got to go back and we got to go to certain assumptions. This assumption of 6% of the internal rate of return on this policy, the crediting rate assumption, I should say, on this policy. Now, if this policy doesn't get that 6%, right? If it only gets 4.5%, I'm going to run some numbers here. I want to do this kind of on the fly. And this is the thing. I haven't spent a lot of time prepping this. I'm just kind of winging it and going based on what I know and based on just trying to keep this as simple as possible and educate. So once again, if there are any questions as I'm going through this, then please, please, please let me know. So what we have here is policy value 1654, 301 times 0.06 is 99,258. So if I'm taking this 1654 and I'm doing 6%, that's 99,258. So we're doing interest crediting here. It's actually crediting this 108,000 here is higher than the 6%, which is actually kind of weird to me if we're assuming a 6%. So that actually tells me it's more than 6%. It's probably 6.1 or 6.2 is the illustration rate being run on this Transamerica account. Actually, let me figure that out. 108, 700 divided by 1654. Yeah, 6.5% is the illustrated rate on this. And so when we look at 6.5% is the illustrated rate on here, what this is saying is anything under 6.5 is going to be negative. So this is where when people go, oh, it only takes a couple, the market would have to be really bad for 8-9 years in a row. Well, here's the deal. This net amount at risk is going down, you can see here, from that point on, right? It goes down, it's going down, it's going down. But that's, once again, this is based on certain assumptions, and that assumption is that we're getting that 6.5% return inside of this policy, that you're getting that crediting rate. Now, in a year where you have a flat market, let's say it was 20, let's say you're 66, and this is your policy, and you have $108,000 of interest crediting assumption here. You have your policy, your fees of 14.4, your admin fee of 120, which is not horrible, right? If you were paying the 14.4 and the 120, that doesn't seem that bad, right? Because you're like, it's just a portion of what I'm getting credited. I back that out. It's no big deal. You're looking at $14,520 with those two things together. But now if we have a flat year, now what happens is this 108 doesn't get credited, and the problem is this actually performs. The policy value goes down, the net amount at risk changes, and the cost. Like what happens when this net amount at risk is changed? Let me do this. Let me try to clean this up a little bit to try to make it easier. What really happens here are these two numbers here are dictated by the net amount at risk. Okay, I got to delete that. With these two numbers there are dictated directly by the net amount at risk. So that net amount at risk is what's determining those two costs. right? So if this doesn't perform and there's $108,000 of money that's not credited, then the net amount at risk is going to be impacted, and therefore you're then going to have less money. You're going to have in credited in cash value. It's going to operate less efficiently. You're going to have to pay for these insurance charges. These insurance charges are going to go up because the net amount at risk is actually going to be higher because the market performed worse. So when people say, well, you can't lose money due to market loss, market performance, well, you can't lose money. That $108,000 won't get credited, but you actually in turn do lose money in a way, because what happens is when you don't earn money here, if that's gone, the cost of this go up, which drive the cost here up, right? So the costs right there go up. The costs right here are higher based on the net amount at risk, and so therefore you're then losing money. Now, if you have that happen a couple times in retirement, it doesn't take much for the wheels to kind of fall off and for these policies to blow up. Now, once again, I could go through this and I could say, all right, let's add up all these numbers. Let's add up all, I'm gonna just do this. Let's add up all these numbers. If I were to add all these up and say, let's just do it, man, I don't even know if I have the patience for adding all these up. But cost of insurance alone in this, just the cost of insurance. And once again, this is based on net amounts at risk, right? It's assuming that, like you can see here, $76,000 is the cost because the net amount at risk in the policy is going down. It's only $83,000, but because you're 95 years old, that cost of that annual renewable term, because it's never fully paid up, is astronomically expensive. It's just, it's almost, they say, hey, actuarially speaking, you're going to die at some point in time when you're 95. They think it's virtually inevitable that you're going to die. And so therefore the cost of insurance is almost as expensive as the net amount at risk. Now what happens at 86 years old, when your insurance costs are $52,000, when you're assuming you're getting $352,000 of credited interest to your account, but then that $352,000 doesn't happen that year because it was a flat year. Now the net amount at risk goes higher, and when it's higher, when you're at these higher increased ages, it gets astronomically expensive. And this is the problem when people are utilizing IUL as income vehicles. When you're utilizing, think about this, when you're utilizing these as income vehicles, you're typically not starting utilizing them for income until you're somewhere in the 65 to 66 range, or even the 72 range. Maybe you've spent down some other money, you're letting this mature. I've seen a lot of people do that, but here's the deal. If we look at this, and I'm gonna actually just try to, once again, clean this up because I draw lines all over the place. But if we look at this and we say, hey, let's say we were starting at 72 years old, and that's what we're looking at. You got $19,000 in charges. You're assuming, plus the 120, so like $20,000 in total charges. It's assuming you're getting a $154,800 interest crediting. If you get a flat year that year and maybe the next year, you're looking at extra $300,000 that you didn't see. The net amount at risk goes higher. These charges and fees can double in a heartbeat, and that has this snowball effect. We talk about the power of compounding. The power of compounding works against you in these policies when you do it. The difference here is when you look at these policies, when I say IUL is a more expensive insurance than whole life, I got news for you. This is why. All you have to do is go look at the cost of insurance and you look at it annually. Now, what will happen? You are looking at IUL is going to look cheaper on the front end, right? When we look at year 1 through 20, it can look cheaper. There's no doubt about it. Does it make it cheaper? No, this is just illustrations, right? That's with inflated assumptions, right? I created the IUL challenge because bottom line is these policies never perform the way that they've been sold, the way that they're illustrated. They hardly ever do. We're talking 99% of IUL sales over the past decade during the greatest bull run have not met the expectations that they were sold based on. So in a market where we had the greatest bull run of all time, with a product that was sold on upside potential, and downside protection. If they didn't capture the upside potential in the greatest bull run of all time, what the heck are they going to do when times get tougher? And so that's why I'm really passionate about people understanding what is really going on here. And so they may look cheaper for 18 years, but the bottom line is you are making a long-term decision. Don't make short-term decisions based on long-term goals. You've got to make a long-term decision based on a long-term goal, and you have to look at, is this going to accomplish? If these policies are being sold as a retirement income supplement, we have to look at how are they going to behave during the years when we want to leverage them most, right? And this is where they actually perform the worst and look the ugliest, right? And so when you look at that, that's why I have a big problem with them. And so now there's two things that are going on here with the IUL. The cost of insurance is crazy. They don't perform well from a long-term income distribution perspective, because now I don't even have this on here, by the way, but if I started taking loans for income, that makes this way worse, because now let's get into this, and I'm just going to use this example. You're assuming you're going to get 108,000 credit right here, right? You got 14.4 and 120 is the charges. The net amount at risk is 452. Well, what happens if I take I got 1.6 million. What happens if I take a 50K loan, right? And then the market goes down and I have a loan charge on that of 4%. Well, now those extra loan charge costs, because there's no crediting happening in a down year, the illustration is showing positive crediting every single year. The reality is that's not going to happen. And when that happens, and where we have a no crediting being credited to the policy because of a flat year, then we have the charges, and then we have the loan expenses and the interest that's paid on that loan that goes into it. That's where the wheels come off of these things. Now, I know that some people are going to say, oh, that's just Transamerica. I don't like them. I don't sell them. Every single IUL policy functions in this way, some way, shape, or form. Not every supplemental illustration, as far as the costs of insurance and the value, like everything that goes with it, not every illustration with every company is as transparent. One of the reasons I showed the Transamerica, even though I don't like it, the reason I showed this is because of the way that they lay this out on the sheet, and it's much more transparent. So that's pretty much the only thing I could say that's good about this policy. And when we look at this, and you look at the fees, and then you look at the other variables that get impacted, like cap rates, right? Like as cap rates get reduced, think about it this way. As cap rates get reduced, which they have been, then what's going to happen is this 6.5% assumption that's operating in this thing will go down, right? As par rates get reduced, participation rates, that number goes down. As spread charges, if there's a no cap fund, increase, this assumption, the performance in this policy will go down. And so the only thing I guarantee is that the policy will never perform as good as this, and then the compounding effect as time goes on, when you hit your 60s, this time right here, and you start looking at the interest charges, the cost of insurance, and when you start hitting your 80s, late 70s and 80s, when the mortality expenses go through the roof, because this is annual renewable term, when you start having those fees and expenses, that's where the wheels really start falling off this. And if you're depending on this for income at that point in time, it completely blows up, and you're going to have a lot of challenges. I've seen more lapse issues, more people run into problems with this product than anything else. And so, all right, so now that we've covered the cost of insurance on IUL, I want to and gone through and talked about all the variables that kind of come into play, things that are out of your control, the net amount at risk, the way that the indexing strategy can affect the net amount at risk if the policy doesn't perform properly, the fact that it's annual renewable term and it gets massively more expensive during retirement years when you're definitely planning on taking more loans, the fact that when you're taking those loans, that adds more risk to the policy. All these things come into play with IUL, and it's a catastrophe waiting. It's really what it is. The reason I like whole life is because there are more variable or less variables. The variables are taken off the table, right? And it's more transparent. Now, is it a little more expensive insurance at the beginning? Sure it is, because the cost is all a function of risk, and the risk is super high, and the risk is on you, the insured. So the life insurance can make it be perceived to be cheaper, and it can be cheaper up front, because at the end, when the risk is really higher, they offset that risk to you in IUL, and in whole life, they take on the risk. The risk contractually in whole life is with the insurance company because you can completely pay the policy up in the years when the insurance is the most expensive. Does that make sense? And so now what I want to do is I want to share the illustration, and I'm going to actually share a full illustration here of what it looks like for this policy here. Now what I'm going to do here is I'm going to zoom way in, and you can see here I'm using the same $20,000 a year premium. And the thing I want you to see is over on the other policy, we were looking, the net amount at risk is $451,000. So you do get a little less insurance here, right? The net amount at risk you're looking is about $400,000. Now what's going to happen is as you put the premium in, the death benefit's going to go up, the death benefit's going to go up. By year 10 in the other policy, you were looking at, you had about $700,000 of life insurance. In this one, you have about $788,000, so you're ahead. The net cash value in this, the cool part about the whole life policy too, is even though they say it may cost more, and there are costs, it's more pure, and I'm gonna get to that, the liquidity here, even though the IUL said that the policy value was $18,894 in year one, then you have to back out the surrender charges after that $18,000, and you probably only actually have liquidity in most cases of about $5,000 to $6,000, if that, by the way. Now, with this whole life policy, instead of having $18,000, yeah, you only have $16,000, but guess what? That $16,000 is your net cash value. There's no surrender charge above and beyond what that number is. What you see is what you get. This is a much more transparent experience from that perspective. Now, we have this funded, the whole life and IUL are completely different in the way that you fund them because whole life insurance will effectively be paid up. Now, the example that I'm showing you is a fully paid up policy at 75. That is just what this carrier does. They have this policy, this specific product is paid up fully at 75. We do have other carriers that you can pay up at 65. There are situations where it's fully paid up at 95. It really is up to you how you want to design it. Just know the earlier you do it, the cost of those insurance for the lifetime of the policy get jammed in and paid in a shorter window of time, right? Like if the full endowment of a policy is supposed to be paid through 120 years old, they basically take all those mortality charges and they kind of compress them in a shorter time frame, but that also, in doing so, can help the dividends operate efficiently as well. So when we look at this, I think an important thing to see and to understand here is on the charge side, we have a term rider, and I'm going to show the expenses behind this for the first 20 years, and that gets us more insurance. You have 1.287 at the $1 million of insurance. At the end of that term, 20-year term rider, the insurance drops off and you have $1,041,000. So, $240-something thousand of term insurance dropped off. But you still have your insurance, and as you keep contributing, as you keep earning dividends and the policy's growing, the death benefit kind of rebuilds, and that is what it is. Now, you can see here that the policy at 75, when you see zeros on this illustration, this means you are never going to have to make another payment. There are no more charges, there are no more fees. This policy is completely paid up at this point in time. You will never see that on an IUL. It is physically impossible to actually pay up a policy. That is the Achilles heel of universal life chassis products, is the fact that when you get older, when the insurance is more expensive, all these years where you have no costs in whole life, you are paying tens of thousands of dollars. In fact, what I'm going to do here is I'm going to go back to this just to remind you, just to kind of show what I am talking about here, right? So as we look at that, all these years, let's go into the 70s and 80s, 76 years old, where we paid up this policy right here, these years, 76 years old, we have 23,000 the first year, all the way up to 48,000 right there. So let's go 48, 100, 20, 150, 60, 70, 80, 90. You got $300,000 of insurance just in that range. And I'm just doing quick math. That's $300,000 is the cost of insurance while you're in retirement. So I want you to really think about that and really break that down and really understand that and like really just process that for a second. And what I'm going to do here now is I'm going to go down and I'm going to get into the cost of insurance for whole life and break it down. And you can see here, this breaks it down. This gives it to you. It basically breaks it down and they say, hey, cost per $1,000 of insurance is what it is. They break it down. It's $42 is the guaranteed. That's the worst it's going to get. But this is the net cost after everything, assuming certain dividend growth and the policy performance. As it's projected here, it's $26.61. Now, this used to be better than this when it was projected, when dividends were higher and so on and so forth. But the bottom line is we're at the lowest all-time dividend rates we've seen in like 80 years. And so therefore the policies illustrate worse than they ever have. The difference with whole life is I believe that they could actually outperform illustrations moving forward as the dividend environment and the fixed market environment as interest rates keep going up. Whole life insurance policies will perform better, very similar to the way that they improved in the 80s after the 70s, right? And so that's important to understand. Now, you can see the coverage, the base policy of the insurance. You have $90,000 of base policy, but you have a $275,000 rider. This is what you're getting charged the insurance on. You got $4,000 out of that is the base, $360 is the term rider, and then the balance, $15,639, goes into what we call paid up additions, and the paid up additions basically go into the policy as cash. And so you could see you have $19,999. And when people say this isn't flexible, you could pay as little as $4,480 in this policy and you'd be okay. You're going to keep the policy in force. Anything between $4,480 and $19,999, $20,000 is going to keep this policy healthy. Obviously, the more you fund it, the more the cash value will be efficient and will accumulate. That's no different in whole life than it is IUL. But this is a massively misunderstood thing. I don't think most IUL agents even understand that whole life can do this, right? And so when you look at this, it's that simple. Like, I don't know how you look at this and you say, oh, the surrender charges are baked in, right? I'm gonna go back up here. I don't know how you look at this and you go, oh, the surrender charges are baked in, the insurance costs are baked in. This is a fully paid up, which IUL can never be fully paid up, so therefore the costs get astronomically higher. And mind you, what I showed you on that illustration, that was an illustration kind of best case scenario based on the current assumptions. It's gonna perform worse, meaning the costs are gonna be higher than what I even showed you. I would put money on that. And so at the end of the day, what it comes down to is you just understanding what you're buying, understanding that, that IUL is simply universal life, which is an atrocity, and you're attaching an option strategy to it. Because it's universal life, it's an annual renewable term, and the amount you get charged for insurance on annual renewable term is based on your age and the net amount at risk. As you get older, those costs, just like with term insurance, go through the roof. If the market performs poorly, if you have loans against the policy, which, let's face it, if you're thinking about buying an IUL for income, you're gonna have loans against it. They add exponentially higher amounts of risk to the policy. And as you do that in retirement, as you're getting older, all those things are working against you. It's like the perfect storm for having massive problems with your policy. The policy is gonna lapse. If you don't have a overloan protection rider, you're gonna run into a taxable event. And the bottom line is, the thing I preach all the time, and the importance and the most number one important attribute you're looking for in your money is control. So the reason that I'm so high on whole life insurance over IUL is the fact that the projected returns in a whole life policy are a little less, there's no doubt about it. I would argue that they'll probably be closer to each other than the illustrations show with IUL. But more importantly than that, I'm thinking about what's the upside, what's the downside, can I live with the downside? So even if the upside in IUL is a little bit higher, the loss of control and the additional risk that we take on later in life when we need this the most is higher, and that downside goes through the roof. Therefore, the risk is higher, That's not something I want to take on. When I think about what's the upside, what's the downside, can I live with the downside? I showed you the downside and what it can look like in an IUL, and that is something that, in my opinion, every single human being on this earth should want to avoid. So if you have any questions about this, feel free, comment in the comment section below, reach out. If you have an IUL, you want to have it evaluated, reach out to my team. You can set up a free clarity call using the link in the description down below the video here. And hopefully you found value in this. If you did, please share it out. I know a lot of IUL agents don't understand what I'm talking about. They couldn't articulate it. And honestly, even if you understood the IUL side of it, you probably didn't understand the simplicity of whole life and really where that power lies and how it adds that extra level of control in your financial life and the value and the power behind that. So that's it. Until next video. Have a blessed, inspirational day. We'll talk soon. See ya.